2023 financial simulation. Coming out of the basement today. Look at this. If you're thinking about alternative investments, listen, we can negotiate prices, okay? Anyways, today we're talking about equities. Okay, so module 4, actually this is module 4, not module 5. Sorry about that. I think I didn't module 4 because I just talked about module 3, which is asset allocation. So in this module, about equities. Okay, and so in the asset allocation model, we talked about sort of the different asset classes that you can invest in. So you can invest in cash, fixed income, you got alternatives, real estate, and equities. And for whatever reason, well, I know why, equities are the most sexy. It's the most interesting. Everyone wants to talk about, when we talk about investing, everyone's always talking about the stock, right? You have a friend, you have a teammate, you have a relative who probably made out like bandits, made a wicked pick on a company, you know, and you said, I want to do that. I can do that. That person's not that smart. I can do it, right? And so media is all about stocks. It's all about equities. Or not today, module 4, module 5, we're going to be talking about equities. And today I'm just talking about stocks, and then module 5, what I want to do, my team's process, how we kind of go about thinking about, you know, making a purchase and buying the stock. So that should help you in making process. Okay, so let's jump into it. What are stocks? I mean, I think everyone has a pretty good understanding about it. We talked about it in the last module on asset allocations. As you can see, in stocks, because arguably that's where you make your most amount of money. World are business owners, right? Like they're business owners, they own companies. And so as I said before, when you buy a stock or you invest in a company, you're a business owner, like you own the company, right? So that's a relationship here. So as you can see in this chart, and again, as I said, this goes to 2017, but you run it up to 2023, it'll still be that straight line up. It'll be surpassing all the other equity classes or all the other asset classes by far. So anyways, that's kind of, you know, what a stock is. It's ownership in a company. We talked about this before, common shares versus preferred shares. I don't want to belabor on this, but really what I'm focusing on tonight are common shares. Okay, that's an ownership and equity stake in a company. And so not only do you get to participate as things and profits and dividends and all that kind of fun stuff, but you also have the ability, and I didn't talk about this last time, to actually go and vote on. You know, it doesn't. Yeah, sure, you may only have one share of, I don't know how many shares are out floating around, but you still have ownership stake, right? I mean, common stock, you have voting rights. The value of doing it, you earn return from an increase in value of a company or payment of dividends. Preferred shares, no voting rights or claim to assets, but you do get dividends. Class of preferred share or the company that you bought it from. And then fixed income, not at all related to this, but in this situation, you're lending money, you're owning an asset, right? So it's like bank, they lend you money, and on your mortgage, the bank could, you know, come and foreclose your house and take it from you and sell it. The stock is, and I apologize, a bit of a tangent there, it kind of threw me off. So why buy stocks? I mean, you buy stocks because you can return they got, right? The 10 bag or whatever you want to call it. But that's how you make money, okay? You make money with in Canada, we'll pay a dividend. Thing in the US too, actually, they don't pay a dividend, they do what's called a share buyback. And a share buyback is, you know, buys back the shares, and by virtue of doing that, they reduce the float of shares in the E share. ultimately increases the buybacks, a huge thing in the US, right? It's your portfolio returns, reducing risk, and also it's an inflation hedge, right? And so what I mean by that is think about it this way. The prices we pay for goods and services increase over time. They have this like past couple of years, right? And so who is benefiting from that? Well, is if you drive a car that requires gas, and gas prices are going up, well, look at the companies that sell gas, that produce gas, that refine gas, right? And you can see how it kind of correlates there. And that's not a perfect example, but it should give you some sort of idea as to kind of how it all works, right? So it's a bit of an inflation hedge. Again, I've alluded to before, the return attributes of a stock. Well, you get capital gains, you get dividends. You buy something for $1, you sell it for two, gain, right? And that's kind of one of the objectives, one of the things that you're hoping to achieve with the stock. We're sort of aspiring to the earnings. So when a company makes money, they have the ability to either reinvest it, they pay down debt, uh, they may do more with that money depending on what they want to do, invest in their own company, organic growth, or they distribute it to shareholders through what they call a dividend. All shapes, sizes, and forms. Just like, you always have that willing to do whatever it is to kind of get to the top as quickly as they possibly can, right? Lots of kind of go through that life cycle of being an athlete. You kind of go through the growth phase, maturity phase, right? Where you go from being like, it's like that LTAD thing, right? It's like, learning to train, training to race, racing for fun, or racing to win, or whatever those steps are. I can't even remember. It's been so long, but it's the same kind of idea, right? When you get to that kind of mature stage of your career, all you want to do is you're just focusing on how to be a better, performer. How you're going to win races, like all the sort of the strategy. Younger guys, the younger athletes, sorry, who focus on just going as hard as they possibly can because that's what they think requires to win, right? So, not the perfect analogy, but I think kind of relates to it. And so business is the same way. And so, wants to buy, get in early, get in on that company that's up and starting, that's emerging, and those would be sort of those that through the entire growth phase, right? And we always hear about these companies that are once $1 and 1,000 or more, right? And you're like, oh, when am I going to find that? And those are hard to come by. And then people who tell stories about an investor, right? And it's you work with where I look at their existing holdings and really were the ones that bought them for 20, 30 years, and you can see the impact of compounding and the growth of these found and kind of inspiring to a certain degree. But more often than not, someone will buy a company, they'll be an up and starter, they'll make quick 20%, maybe they'll double their money and then they're out. They don't allow it to kind of go through the full phase and really realize that impact. And that happens all the time. So if that's you, you know what, don't worry, you're not alone. But ideally what people are looking for hundreds of, well, Apple, I guess, hasn't been around for 100 years, but it's maturing its life cycle. But companies that have been around for a long, long time, right, and continue to kind of grow at a slower pace, and depending on tolerance, maybe you'll have a little bit more of. You may have kind of crafted for yourself. Or like, well, you know what, I don't need these funds for another, say, who's just about to retire, and you're thinking, oh geez, I need these funds to kind of make me money. I don't want to take too much risk. Well, at that maybe you'll be looking for more mature companies, ones that have been around well. Maybe they're paying dividends right where you land and where you kind of go towards. Well, it's kind of stick with the tried, tested, and true. It all depends, really. Into, I mean, you're going to have companies, as you can kind of see in this chart down here. You know, they're going to have more. These are uncorrelated here. They're not supposed to be, but typically what you're going to see is you're going to the economy. You know, there's going to be ups and downs in the economy, and typically the performance and their value will go up. And the ones that are sort of those up and comers, they're going to have a little bit more higher volatility, but you know, better opportunity to make a lot of money, but at the same time, a larger probability of losing a lot of money, right? You know, it happens all the time. We've seen these companies come. So that's kind of the diversification, and most time people will have some sort of element. There's a lot of portfolio around it. I mean, oh, stuff. Oh, modern portfolio theory, I believe it was. I think I get into Famine French. That's who it was. And you have small cap, growth value, large cap, growth value. A lot of people, their factor analysis said the best correlation or the best composition of a portfolio is one that has a nice combination of small cap growth and large cap value, and kind of pair those together, and you're going to get the best kind of possible. So there's growth and value. 2020 degree value was in style. It came roaring back. And I wish I put the slide in here, but I have a really good one that shows kind of the differences between growth and value and how they've performed over the years. And for the last little while, for the last 20 years, I think growth outperformed value. I want to say of the time. I'm thinking like Anchorman right now. If you guys all know that movie, it works every time, 70% of the time, or whatever he says. But anyways, growth over the past, that's attributed to the fact that we've been in a lower interest rate environment, and which sort of propels more growthy or is like just GDP growth is really well because they've been able to grow attract a lot of value. You know, a lot of people were suggesting that it was quite frothy in the growth space. You know, a lot of these tech companies, a lot of these other companies increases, you know, the valuation is just going to make very much sense. And so all of a sudden value, which had been out of style for so long, and you know, these are typically, you know, consumer staple companies. Anything that's super exciting per se, but you know, they're interest rates were rising, and you know, we had no idea how high they were going to go. Well, we still don't, but so when it was going to stop, and because of the correlation, won the game last year. Oh, so I mean, you manager who's going to be more growth oriented or just entirely growth oriented. You're going to have portfolio managers that are more value oriented. And the key thing here, depending on what you want to do, it's kind of flip flop. It's easy to growth is in style. I'm going to flip over into growth, and then all of a sudden growth goes out of style. And you're like, oh, I'm going to flip over into value. And by doing this consistent sort of trade back and forth, you end up just kind of burning yourself. Be a value investor the last 20 years or so, because you've just been, so, I'm not, but just understand that there are differences here. And, if you're someone who's going to be going and investing in an ETF or something, just look at the attributes of the actual holdings to make sure that, yeah, it's a value oriented fund or ETF, or it's a growth oriented fund or ETF, whatever it may be. So, commonly what makes a growth company? Well, these are industry or the market. They're doing a better job at getting new customers. There's right, or consistently grow their revenue if they're not making any money, because and they've just invested so much money in their technology and get to that scale where the flywheel just keeps going. And these as like, when a country wins an Olympic bid and they have a sport and they're terrible in that sport, like maybe they've had one or two people show up championships just because for whatever reason, but then they win the Olympic bid and all of a sudden this country hires the best coaches, they build this team, right? It's everyone going to the competition. You're just like, holy crap, just a ton of money has been piled into this just to make it so that one or two of the athletes will, get close to the podium or whatever. Growth is that you want to avoid the growth trap because, as I said, there's technology companies more and more often cycle. And so that's what we always want to be mindful of. And you don't want to, and either they're in that declining phase where they're hopefully trying to get bought out, or they have, you're seeing that with Facebook and changing their name to Meta, right? It's like, really good example of how that sort of played out, right? Which is, I mean, Warren Buffett here, he is your value investor. I mean, what the market sentiment. So, particular company sector or so forth is just totally out of style, super cheap. Okay, I'm going to buy. High quality value. In the public market university news cycle, the various strains, it's very difficult to be able to, differentiate you from everyone. investing, right? So you're looking for a dividend and the sustainability of that dividend. So you're always, you don't really care about the growth of the company. You're just looking growing 10, 20, 30% a year. They just continue to just for service that is either regulated or, you know, maybe the company's going close to bankrupt information on this company, or just people are not looking at it. And guess what? It's time. And I think, like, growth really boils down to the amount of research you're going to want to do, right? It's because they're small, that company would. And if you really want to kind of do this deep value investing and try to find something, that's where you're going to find it, right? And oftentimes it comes with you or having like kind of a knack or a deep understanding as to what's going on in that particular company, or what trend that's going to be prominent, that's going to take off, right? You have to know it really well. When you're thinking about stocks, there's just a few different styles, right? Like you have different bottoms up analysis. Pick the country, so Canada, the US, etc. Then I'm going to look at a recession or as an expansion. Maybe I'm going to be looking at particular sectors that do well. You know, so that's kind of analysis. You sort of start at the top and you kind of work your way down to pick is that's going to fulfill your needs or fill your thesis, I suppose. The bottoms up is totally different. It's just like I could care less that's going to make the most amount of money or do what it needs. And on your approach, I mean, oftentimes you'll come to the same divergence. I mean, really what happens is, okay, more research is required, but the bottom up, more often than not, people will just sort of, focus on a good athlete. You got to put that time and energy into sort of picking that and doing that work, right? The other kind of approach that's really interesting is the factor-based approaches. Okay, and sorry, let me just go back here. So this is like more fundamental analysis. Okay. So do I talk about technical? No, I don't. We'll talk about technical in factor-based approaches are really interesting. You could care less in factor-based approaches. You could care less universe or environment, right? So this is using big data, machine learning. You're going to generate alpha, right? So you're going to say, okay, Excuse me. But I mean, it's keeping a good eye on all this sort of stuff, right? So if you're a growth investor, you're going to be looking more at momentum. Value investors have said quality value, small cap versus large cap. What's the better, right? And how that sort of fits into everything. Responsible investing. This is something that I kind of developed a bit of a passion or interest in early in my career because when I was racing, that are going to solve this, right? Infrastructure, the whole life, everything that's being impacted by climate will definitely for this stuff and a need. The best environmental companies or ethical value or socially responsible investing, I guess, comes into play, where you're saying, okay, I'm doing some negative and positive screening. I want to remove a sector or company because it's just at odds with my values, right? And then you have thematic impact investing, where you're trying to invest in specific, excuse me, in a specific theme, right? So climate change is the big one, and that's garnering a lot of attention. A lot of the funds are being geared towards thematic investing to a large degree. And managers so think about it this way too. It's just like, well, we all aspire to do it anyways. It's like one team every single year, right? It's very hard. And so in stocks, and I mean, like when we think about equity, you can invest in stocks individually, or you can buy a fund, or you can buy an exchange traded fund, an ETF, and be passive, which just tracks the market, right? And the problem with it that this is when you're in a passive exchange traded fund to some degree. And then if you're like, oh, I want to invest in Apple, I want to invest in like that's kind of my take on that, right? The other thing too is that index investing, so that's passive investing, has just blown up. There's just so many options out there right now for anyone, and they're cheaper and they're better than say like an active mutual fund or something like that. But again, there's a time and place for funds, and there's some markets that are disjointed. They're not efficient because the thing with passive investing and the market that you're investing in is efficient, right? All the I'm not going to go pick some concept that you should do, right? Easy to buy indices, but it's really what you're looking at, Canada. You know what I mean? Like you can buy specific regional markets. You can even buy even countries. So you can buy you can go, more regional earlier. You can go national, which is just country specific. Industry, you can say, okay, I want to take a bet on clean technology, or I want to take a bet on agriculture. I want to take a bet on um, uh, and then there's these exchanges, so specialized indices that maybe brand or focus on specific attributes. So that'd be more like the it's kind of this first set of introduction. I think there's just so much more to learn, but I hope gives you a little bit of an update as to what it is. I mean, I have a couple of recaps here, and I don't think I covered this, but I mean, the one thing and sort of some of the approaches. Peter Lynch writes this book. He was a portfolio manager for Fidelity, which is a big mutual fund that you don't know or you can't explain, right? Holds true, but there's more to it. And again, that comes from a different era. And about picking stocks They're going to pick stocks or buy an index. I mean, if value, and if you're not on top of it, you may miss the mark to sell, right? Or whatever it is, right? Where with an indice, well, the market just what will helps and get there's no try to point you in the right direction or one direction, then maybe it'll help you with today. Thanks for tuning in and